You could think of gold and the dollar as two competing monies or currencies, things that people can hold. And gold, based on most estimates we have from the World Gold Council and others, has a supply growth rate annualized of something like 1 or 2% per year. We look at new mining plus the tiny amount that's lost, and then the estimated stocks of refined gold that exist in the world. It's got this growth rate of 1 to 2%, averaging around 1.5%, which is pretty reasonable. In most contexts, it doesn't pay you a yield to own it. If anything, you have a minor expense for storing it. Whereas dollars or dollar equivalents like treasuries, dollars historically grow at about 7% in supply per year, broad dollars. Most other developed market currencies are similar, with emerging market currencies generally being higher. And you do get a yield offsetting that. Now, in many years, especially recently, especially throughout the 2010s, that yield is way lower than the supply growth rate. So basically, it's a new regime change, right? And so it's a different investing environment than most people are used to over a, call it a 40-year investing time horizon, basically anybody alive and trading today. And so for the past 40 years or so, kind of before 2020, we can call that period monetary dominance. And that's an environment where, for example, bank lending, and by extension, the central bank that, has various tools to accelerate or pull back on commercial bank lending, that's the more dominant thing that causes kind of business cycles and contributes to what's going on. And what happens over time as debt builds up, especially on the public side of the ledger, so the federal ledger, we gradually shift over more toward fiscal dominance, which is to say that fiscal deficits are now larger than the amount of new bank lending in a given year, and even the amount of bank lending plus net new corporate bond issuance. And so fiscal dominance is a more driving aspect of the economy. And then also there's the added issue that, when central banks try to slow down inflation or slow down the economy in general, when they raise interest rates, they do that to try to slow down bank lending. And the problem is that, when you have, say, 30% federal debt to GDP, that works pretty well, because when you raise interest rates, you slow down bank lending, and while you do contribute to the federal deficit because you contribute to the federal government's interest expense, the slowdown on bank lending is larger. But when you fast forward to the present day and you have something like 120% debt to GDP and you raise rates, while you do slow down bank lending, you actually blow out the fiscal deficit even bigger, even by a larger absolute dollar amount. And that's actually somewhat stimulating for parts of the economy that are receiving it, and somewhat inflationary as a cost of that. And so basically their tools work differently when you have fiscal dominance. And it's not just like a one-year thing or a multi-year thing. It's kind of a new regime that we find ourselves in more structurally compared to that past 4 decades.
In the past, hiking rates was a reliable way to rein in inflation. But with today's swollen deficits, higher rates now balloon government interest payments, which paradoxically fuels demand in parts of the economy. It's a catch-22. Raising rates curbs lending but worsens fiscal deficits. This undermines the effectiveness of central banks like the Federal Reserve. Their tools, designed for monetary cycles, are ill-suited for fiscal-driven inflation. Policymakers find themselves managing symptoms rather than causes, while real levers, taxation and government spending, remain outside their control. In short, higher rates no longer guarantee stability.
Yeah, during fiscal dominance, I would certainly not want to be the head of a central bank because basically all answers are bad. And it's mainly because the issue is just outside of their purview, and it's outside of what their tools are designed to do. So their tools of interest rates are primarily meant to either accelerate or decelerate bank lending, and therefore, fractionals or money creation, or they're meant to basically harden the exchange rate compared to other currencies and make it, disinclined speculators from, say, borrowing the currency to buy another currency or something like that. And so they have that tool to try to slow down inflation, and it can work under certain environments. But the costs of doing that are different under different environments. So we have this notion that higher rates can tamper down inflation, and we primarily get that from the 70s. But that was, again, a very bank lending driven type of inflation. That wasn't primarily because of fiscal dominance. Whereas in the current environment, bank lending rates are normal, and they were normal throughout the whole kind of pandemic lockdown and the inflation period we went through. None of that was because of excessive bank lending. Instead, it was because of very large monetized fiscal deficits. They were explosive, obviously, from the 2020 and 2021 period. Now they're less they're less gargantuan, but they're still sustained at that 6 to 7% GDP level. And so as they try to raise rates, they do get the effects of less borrowing and a harder currency compared to other currencies, but then they blow out the fiscal deficit. And so really, it's kind of like treating some of the symptoms and even exacerbating, ironically, some of the other symptoms rather than really going after the root cause, because the central bank doesn't have jurisdiction over taxing and spending. And so the best they can do is mention it. And it puts them in a really difficult place just because their tools either they have mixed results rather than clear outcomes. It's almost like a patient with multiple conflicting ailments, and a medicine that might fix one ailment makes another ailment worse. So there's kind of no good answer at that point. And that's really what the Fed kind of finds itself in.
Historically, gold moved inversely to interest rates. Investors shifted between gold and dollars depending on which preserved value better. But this relationship is weakening. Despite aggressive Fed tightening since 2022, gold has remained resilient, climbing above $2,500 in mid-2024. Why? Because higher rates no longer slow the system as they once did. Instead, deficits keep injecting liquidity. Investors, wary of currency dilution, increasingly turn to scarce assets, gold, Bitcoin, and commodities. These hedges thrive when money supply grows faster than productivity. Unlike fiat currencies, gold supply grows only about 1.5% per year, preserving its scarcity advantage.
So it partially ties into what I mentioned before, that higher rates in some ways accelerate things rather than decelerate things, as they would under a more monetary environment. If you go back on why that inverse correlation historically exists, you could think of gold and the dollar as two competing monies or currencies, things that people can hold. And gold, based on most estimates we have from the World Gold Council and others, has a supply growth rate annualized of something like 1 or 2% per year. We look at new mining plus the tiny amount that's lost, and then the estimated stocks of refined gold that exist in the world. It's got this growth rate of 1 to 2%, averaging around 1.5%, which is pretty reasonable. In most contexts, it doesn't pay you a yield to own it. If anything, you have a minor expense for storing it. Whereas dollars or dollar equivalents like treasuries, dollars historically grow at about 7% in supply per year, broad dollars. Most other developed market currencies are similar, with emerging market currencies generally being higher. And you do get a yield offsetting that. Now, in many years, especially recently, especially throughout the 2010s, that yield is way lower than the supply growth rate.
Inflation is often confused with currency debasement. While both erode purchasing power, they operate differently. Inflation depends partly on productivity. TVs, for instance, became cheaper over decades despite monetary expansion due to technological efficiency. Gold and other scarce, labor-intensive assets lack such productivity gains, so their prices reflect long-term currency debasement more directly. This explains why real estate, fine art, and energy-intensive commodities steadily rise in value. In today's fiscal-dominant regime, persistent deficits drive debasement even if consumer inflation cools temporarily. For investors, distinguishing between short-term CPI trends and long-term debasement is critical to wealth preservation.
And so you can think of it as like a net result. If you're a 7% supply growth currency and you get paid 3% on it, you're facing a 4% annual dilution rate. And so basically, a lot of investors, there's various mechanisms that they do this, but generally speaking, when they perceive the currency as harder, so they have a higher interest rate compared to the growth rate of that currency, they're more likely to say, I'm willing to hold that currency. But in environments where the yield is nowhere near compensating for that growth rate, they say, well, I might as well hold gold because I can self-custody it. It doesn't have that debasement rate, so the lack of yield is not a big deal because I'm not getting much of a yield with the currency either. And so you have that historical correlation. And what's interesting about 2022 and thereafter is that normally this aggressive move by the Fed, this kind of pretty rapid tightening and a pretty high interest rate relative to the money supply growth rate at the current time, that would normally put downward pressure on gold. But gold and Bitcoin and equities and a lot of other kind of assets with some degree of scarcity to them, they pretty much resisted this downward pressure from rates. And I think that largely goes back to my prior point that there's been a regime change, that higher rates don't slow things down as much as they used to, or more probably a more nuanced way of saying it is that the overall result is not as slowing. They still put down as much downward pressure on some sectors as they always have. For example, commercial real estate, the volume of residential home sales and things like that, all of that is pressured by the higher rates, but it blows out interest expense, which does flow into the economy, and it blows out other parts of the federal deficit. And so when you're in fiscal dominance, rates don't really have the same effect against gold and other hard assets as they do during monetary dominance.
Fiscal dominance creates winners and losers. Those tied to federal spending, defense contractors, healthcare providers, and entitlement recipients benefit from ongoing deficits. Others, like young households seeking mortgages, face higher borrowing costs without receiving fiscal inflows. This uneven distribution fosters a two-speed economy: prosperity for some, stagnation for others. Social divides widen as asset owners gain from debasement while wage earners struggle. Looking ahead, fiscal dominance isn't a temporary phase. It's the new regime. Investors and policymakers alike must navigate an economy where traditional tools falter, scarce assets thrive, and debt-driven dynamics redefine financial stability for years to come.
In general, I would somewhat separate the concept of debasement from inflation, because inflation also has a productivity component in it. So as you increase the money supply, what happens with actual prices of goods and services will partially depend on what's happening with productivity growth. You can imagine a scenario where money supply is growing pretty quickly, but productivity is also growing pretty quickly, and so prices are not. So for example, televisions over the past 20 years, they don't grow in price because despite all the debasement, the productivity of making TVs has been so rapid that it's kind of offset those price increases. Whereas we don't get radically better at making gold, we don't get radically better at making other pretty scarce things, waterfront property, fine art, and anything that's kind of energy intensive and very labor intensive. Those things have generally gone up in price, as pretty close to the longer term debasement rate, because they don't really have much of a productivity offset. And so during fiscal dominance, it depends on what's going on with those productivity offsets, and that can influence CPI readings and so can other things like tariffs or the ways they even measure it. But when you do look at the generally the most scarce things, especially if they're not in a local bubble, like with very high levels of euphoria, you should generally expect that you'll get pretty good sustained performance from those scarcer things. That doesn't mean that you can necessarily buy things at any price. I mean, sometimes things go up really quickly and they're prone to cool off for a half a year or in some cases even multiple years. So you still have to watch out for valuations and sentiment to some degree, but generally speaking, I'm bullish across the board on scarcer assets than what you generally find with currency and with bonds. And gold, of course, happens to be a global one. So instead of an asset that like a U.S. stock that has its revenues earned in dollars, gold is this global asset that floats in multiple currencies and therefore tends to be a pretty attractive debasement hedge.
Fiscal dominance creates winners and losers. Those tied to federal spending, defense contractors, healthcare providers, and entitlement recipients benefit from ongoing deficits. Others, like young households seeking mortgages, face higher borrowing costs without receiving fiscal inflows. This uneven distribution fosters a two-speed economy: prosperity for some, stagnation for others. Social divides widen as asset owners gain from debasement while wage earners struggle. Looking ahead, fiscal dominance isn't a temporary phase. It's the new regime. Investors and policymakers alike must navigate an economy where traditional tools falter, scarce assets thrive, and debt-driven dynamics redefine financial stability for years to come.
Matters because where that debt is held matters. People often say that we owe the debt to ourselves, but that's not really the case. I mean, if you have a certain amount of treasury bonds and I have a certain amount of treasury bonds, we're each owed a different amount of interest and a different amount of principal. What is ourselves in this concept? This is a country of over 300 million people and various entities, and of course some global entities hold our debt. And so all of that is basically we have this shared ledger that we're all attached to, kind of whether or not we like it or not. Our many cases, our income, our liabilities, our assets are often denominated in dollars, or at least a big portion of them. And everyone's kind of figuring out what we're going to do with this ledger, including especially the government. And so the debt, who owns the debt and how much debt there is very much does matter. It's not as though you can just easily take from one and give to another, nor necessarily you should. And so that's why the debt is really an issue. Even though it's denominated as something that the country can print, there are still, of course, consequences when they do print it. And so it's, kind of what I covered in one of those recent pieces is that, for one of the problems is there's a little bit of a boy that cried wolf syndrome here. So there are multiple people in the 80s and early 90s saying that debt was going to be a massive issue soon. And they couldn't really have foreseen some of the disinflationary effects that were in the world. So you had the fall of the Soviet Union, the opening of China. So you had all this kind of Eastern label and resources connect with Western capital, basically a global productivity boom. All of that was offsetting of many types of costs and supplied a lot of resources. That allowed interest rates to get a lot lower than many people could have envisioned in the 80s or 90s. And so a lot of this extended a lot more long than people thought. The issue is that now we basically bounced off zero rates. Now we have over 100% debt to GDP. We're more in fiscal dominance. Interest rates, as I mentioned, have less of an effect. Demographics are now very aged. We have much a top-heavy entitlement program. So Social Security, Medicare, and veterans benefits and these types of things are a lot more expensive on a per capita basis, on the taxpayer base than they used to be. And so these things have real consequences. And while many people kind of expect it to be an acute crisis, like a dollar blow up or something, instead, it tends to be more of a longer term issue. So people often say, when will the debt matter? And I would generally say, well, the debt's been mattering for years now. We've been above the inflation target for years now. And it wasn't because of excessive bank lending. It was because of the fiscal environment. Even when that explosive stimulus was done, it's still elevated because of this more sustained background level of fiscal dominance that we have. And of course, the issue is that when you're kind of running the economy like that from a fiscal perspective, it inherently ends up being a two-speed economy. Because if for entities on the receiving side of the deficits, it tends to be a pretty good economy. On the other hand, if you're not on the receiving side of the deficits, you're mainly on the tight side of the monetary environment. So, for example, someone who's looking to buy a house right now and is not, receiving Social Security, not receiving Medicare, not funded by the Department of Defense or these other kind of big sectors that are on the receiving side of fiscal deficits, they're facing the costs of it, but not really benefiting from it. So you have that kind of heterogeneous mix in the economy, which has really, profound kind of social impacts and economic impacts. And these things are we're working through already, and I think we're going to be working through for many years.